Good morning, everybody. Hope you're having a good day. Today, we want to move into a discussion about audit planning, having finished off last week talking about audit reports. I just wanted to spend a few minutes, though, finishing off the discussion about audit reports, just to show you the old two-paragraph report that I was referring to the other day in class. And this is posted in Blackboard resources for you, so you can see it there. And you recall the other day we went through looking at CIBC's report. There was multiple pages, 4 pages I recall. And this is the old report, which when I first started studying auditing myself, this was the type of report that we had. And you can see it's just 2 paragraphs. And if we look at it, the first paragraph just says, we examined the balance sheet. Now note the other day, it started off by saying we have audited. This just says we have examined, so even as a user of the financial statements, you might wonder, what does that mean to examine something? We've examined the balance sheet of ABC Company as of December 31, 19 something, and the statements of operations, retained income, source and applications of funds, which is currently the cash flow statement for the year that ended. Our examination was made in accordance with generally accepted auditing standards, and accordingly included such tests of the accounting records and such other auditing procedures as we considered necessary in the circumstances. So all we're saying here is, well, we did follow generally accepted auditing standards. We don't say what those are. There's no reference to ethics at all. There's no reference to being independent of management. We do talk about testing the accounting records, but again, we don't really describe what an audit consists of. And then in the second paragraph, we say, in our opinion, the accompanying balance sheet and statements of operations and retained income and source and application of funds present fairly the financial position. We don't talk about materiality at all here. Remember the other day in CIBC's, so we present fairly in all material aspects. Here, it's not referencing materiality at all. So it presents fairly the financial position of the company at December 31, 19, and the results of operations and source and applications of funds for the year that ended. In conformity with generally accepted accounting principles, we don't say what those principles are, whether they're international financial reporting standards or whether they're in Canada, the current accounting standards for private enterprises, applied on a basis consistent with that of the preceding year. And you recall in CIBC's audit report, there was no reference to consistency, whereas, of course, there is here. Note that there's no audit partner noted. It's just the name of the firm, just like we would have today, Deloitte and Touche LLP, or we would have KPMG LLP. The report stated, of course, there's no reference to the office, right, that actually was in charge of the audit. So it would be an easy exam question for me to, just ask you, list 5 differences, right, of substance, we'll say, which differ between the 2-paragraph audit report and the audit report that we looked at, which reflects audit reports given today, CIBC's report being an example, right? We see here there's no reference in here to key audit matters, for example, right? I already mentioned no reference to materiality, right? So it would be pretty easy to identify 3, 4, 5 differences, I'll suggest, between this report and our current standard auditor's report. Okay, so that would be the type of question you might see in this area. Okay, so today we want to move into, I'm just going to pull up the next set of PowerPoints here, which will be Chapter 5. And I need to adjust the screen. Okay, so as you can see, Chapter 5 talks about preliminary audit planning and understanding the auditee's business. So part of what we have to do, and we saw this the other day when we talked about auditing, the audit should be planned. And a key part to planning an audit actually is understanding the company's business that you're going to be auditing, because auditing involves a selection of audit procedures. And how can you decide which procedures you're going to select if you don't really understand the business that you're going to be auditing. So in order to reduce risk of something going wrong in an audit, it's extremely important today that auditors understand the business that they're going to be auditing. So again, I'm just passing through the learning objectives as I have before. So again, this whole section we're going to cover today is really about audit planning and understanding the business that you're auditing, as you can see in the header in this particular PowerPoint. So let's just read the PowerPoint together. It says, before an audit engagement is accepted, whether it is a new engagement, okay, so they're talking about an engagement where you haven't audited the company before, or the continuation of one that was performed in a previous year. So this would be what we call a recurring engagement. So it might be year 5, might be year 10. The auditor has to determine whether professional ethics codes and requirements of generally accepted auditing standards can be met, right? So auditors, before they even approach their work, have to say, can we meet our professional ethical requirements? And can generally accepted auditing standards be met in this engagement? So as we talked about last week, the auditor has to ask themselves, are they independent of the company? Auditors are required to be independent, both legally, in terms of corporate law, and also in terms of the ethical requirements of the profession, which we saw previously. And auditors, we know, have to be independent 2 ways, right? In fact and in appearance. The next point, does the auditor have the competence and available resources to comply with generally accepted auditing standards for the company? So do you have the competence? Right? So that might be a specialized industry issue. So if you want to be the auditor for a mining company, but you have never had any other mining clients, you might wonder, do you have the competence required to do that audit? That would just be one example. Or if you're going to audit an airline and you've never been the auditor of an airline company before, does your firm have competence to be able to audit the airline? Do you have the resources, right? So if you're a small practitioner in Windsor, Ontario, and let's say General Motors asks you to be their auditor, do you have the resources to comply? And General Motors is a worldwide company. You're just a small audit firm based in Windsor, Ontario. You probably do not have the resources, right, to be able to accept that size of engagement. And then also, are those charged with governance, so the board of directors, are they willing and able to accept their responsibilities to fairly present the financial statements? So we've talked about the fact that who's responsible for the financial statements? Management. Who's responsible for overseeing management? The board of directors. Right? So the board of directors and management have responsibilities to ensure the financial statements present fairly. Is management and the board prepared to accept those responsibilities? If not, the auditor should be asking themselves, why would we get involved in this engagement? It doesn't seem to make sense, because we always have to remember the financial statements are not those of the auditor. The auditor's only job is to render an opinion on the financial statements. It's management's responsibility, as overseen by the board of directors, to actually prepare the financial statements, including the notes. The next PowerPoint talks about, okay, if we have decided to accept the audit engagement after consideration of the questions we just saw, auditors prepare what's called an engagement letter. An engagement letter is just a form of contract between the company being audited and the auditors. And that letter normally talks about a number of things. The nature of the audit itself, what an audit actually consists of, right? An audit's not a guarantee. What are management's responsibilities in terms of the preparation of the financial statements, including the notes, ensuring that management and the board's prepared to accept that responsibility. And then what are the auditor's responsibilities, which of course is basically to conduct an audit in accordance with generally accepted auditing standards and to render their opinion based on their evaluation of the audit evidence that they have gathered together during the course of their audit. So the contract just lays out the understanding, right, between the parties. Very important to have an engagement letter in writing signed by both parties, because that represents what the understanding is between the parties should there ever be a problem or a misunderstanding for some reason arise down the road. Okay, risk assessment. We have something in auditing called risk assessment. And of course, auditors in their audit report we've seen say that the financial statements present fairly in all material aspects. But in any audit, as we've talked about, audits do not give a 100% guarantee. Most audits are done with what we call a confidence level of 95%, which means that the auditors generally are accepting audit risk of 5%. What is audit risk? It's the risk of material misstatement in the financial statements. Right? So we measure that risk in a mathematical sense by looking at percentages. So normally 5%. So looking at the PowerPoint, it says the risk of material misstatement in the financial statements is used to describe the possibility that business or environmental risks have resulted in the financial statements not being a fair representation of the company's economic realities. Okay. There is a possibility, right? What's the possibility? 5%. The auditor's risk assessment will identify the key risk areas in the audit. So if we want to minimize that 5%, right, and possibly reduce it below 5%, we have to assess what are the key risk areas, right? What are the areas in the audit that we have to ensure the risk is 5% or less. And because the way we do that, of course, is by performing certain audit procedures in those key risk areas. So as it says in the PowerPoint, the audit team will emphasize those areas. They conduct audits in other areas other than the key risk areas, but they have to at least cover off the key risk areas. But again, in order to identify the key risk areas, you have to perform what's called a risk assessment, right? Looking at the client's financial statements and basically asking yourself, what could go wrong? Right? So as I did auditing over the years, I always asked myself, and even before I would sign an audit report, I would ask myself, what has gone wrong here? Is there anything wrong in these financial statements that I haven't caught before? And when I review the audit evidence in the audit file, do I have sufficient appropriate audit evidence before signing the audit report? If I didn't feel that we had sufficient appropriate audit evidence, or I felt that there were unresolved issues, right, which kept the risk of material misstatement too high, well, we had to do more work, talk to management, right, get that risk down to a 5% level or less. Okay, so we saw in the audit report, the standard audit report, and the one we looked at for CIBC, it talked about, we say, the financial statements present fairly in all material respects. Right? So it seems that in auditing, we have a concept called materiality, which of course we do. So what is materiality? The PowerPoint tells us. It says materiality refers to a monetary amount the auditors believe financial statement users would find significant, or what we call material, to their decision making. So we select a certain dollar amount and we say that if there was an error in the financial statements which exceeded that particular dollar amount, that amount would be significant to a user, or we use the word, it would be material to the user. Why would it be significant or material? Because it would affect their decision. Okay, so the user might say, yeah, if there was an error of over $1 million, that would affect my decision as to whether these financial statements were actually presented fairly or not. So auditors have to identify what the materiality level is, right? But it's in the context of what would the users find significant, right? So the auditors have to select this dollar amount, and that dollar amount we'll see is used in making all kinds of decisions throughout the audit process. So as the PowerPoint indicates, materiality is used for planning how to perform the audit, because we have to make sure when we say the financial statements present fairly in all material aspects, we have to ensure that any errors are below the level of materiality, right? So we have to decide what procedures do we have to perform in order to reduce the audit risk in dollar terms below the materiality level. And the last point here, it says materiality is used to conclude whether the financial statements are materially misstated. So when the audit partner comes to sign the audit report at the end of the audit, they're going to ask themselves, am I satisfied, right, that any errors contained in these financial statements are well below materiality, right? Because if, let's say, during the course of the audit, auditors find errors accumulating to $800,000 and materiality is $1 million. Well, you're pretty close, aren't you, to having a material error in the financial statements. So normally what would happen there is the auditors would say to management, you have to correct your accounting errors to get the errors from $800,000 down to a much lower number, right? So the auditors might ask management to reduce and to correct the financial statements, let's say by $700,000, to reduce the errors from 800,000 down to 100,000. Then the audit partner signing the financial statements would say the estimated errors in these financial statements is $100,000. Materiality is $1 million. I'm satisfied, right, that there's enough gap, right? There's enough space there between the errors we've discovered and what's material that I can sign the financial statements. The risk of materiality, the risk of a material error is low enough, right? In terms of the errors in the financial statement, I'll go ahead and sign the audit report. Okay, throughout the text and as we read the various PowerPoints, as we look at this process as we're going through, we'll have a constant reference pretty well to something called overall audit strategy, okay? And as this PowerPoint says, the overall audit strategy does what? It records all the deliberations, so thoughts, discussions, right? And decisions made in planning the audit, okay? So we have to come up with an overall audit strategy. And there's various types of audit strategies that we'll be talking about throughout the course. In terms of audit strategies, the most normal one is what's called a control reliance strategy. Okay, control reliance strategy. What that means is the auditor is going to put substantial reliance on management's internal control system. Okay, so we don't say internal control reliance, but that's really what it is. We just sort of shorten it up and say a control reliance strategy. In addition to having a control reliance strategy, a second strategy would be a substantive audit strategy. A substantive audit strategy. A substantive audit strategy is where you put very little and potentially no reliance on management's control system, and you do what's called a substantive audit. A substantive audit means that you're going to look at a lot of paperwork, basically, a lot of original documents. Okay, you're going to do a lot of calculations to check numbers that appear in the financial statements. So a lot more detailed approach, right? Most of the time, auditors use the control reliance strategy. The reason they do that is basically most management teams in public companies have very strong internal control systems. They have strong internal control systems because they want the financial statements to present fairly. And one good way to achieve that is by having a strong internal control system. Okay, and auditors know this. So if management does have a strong internal control system, that seems to be a logical and good way for the auditors to actually conduct their audit. Let's rely on the control structure that management has put in place to produce accurate financial statements. By relying on the controls, that management has put in place, the auditors can conduct their audit very efficiently. Very efficient audit reduces cost, right? So this is one way the auditors can make their audit efficient and cost effective, is by using a control reliance strategy. On the other hand, a substantive strategy where you don't rely on internal controls or not very much, it's much more costly because there's more man hours required to do the audit, because you're going to look at a lot more documentation, paperwork, okay? And it just takes more time. And more time means more cost, right? Because it's going to take more hours. Professional fees are expensive. And so in that context, you have to realize an audit firm using a substantive strategy that will result in a very expensive audit normally. Usually auditors will use a substantive strategy where management's internal control system is poor, right? Poor quality. The controls exist, but they don't work, and things like this, okay? So I should mention that when auditors rely on management's internal control system, they just can't accept, right, the controls that management has put in place. The auditors have to gather audit evidence that we've talked about before and determine whether management's internal controls that they have embedded in their accounting system are actually working or not, right? So that's the key. Okay, so when we conduct an audit, what we have here in front of us, PowerPoint 10, gives us an overview of the audit process, okay? And so right from beginning to end. And you see on the left-hand side, it's basically saying there's 3 steps. The first one, we have to conduct a risk assessment, right? In our risk assessment, we're going to identify those key risk areas where we have to ensure a material error has not occurred. Right? We saw that in the previous slide. Identify the key risk areas and conduct audit procedures to ensure a material error has not occurred as a result of those key risk areas. And once we identify those risks, we have to respond to them, right? By responding to them, that just means knowing what they are and then conducting our audit procedures to ensure the risks have not resulted in a material error in the financial statements. How do we respond? On the right-hand side, you see it references internal control. Okay, we have to document the client's internal control system. We have to test the controls to make sure that they're working. Do we test 100% of the controls? No, we sample, right? So management might have 2,000 internal controls in their accounting system. How many internal controls do auditors rely on? Well, in a typical audit, between 25 and 30, okay? So management may have several thousand, but the auditors do not rely on all of management's internal control. They look at the internal controls over the key risk areas, right? Because remember, those are the areas the auditors are most interested in, ensuring a material error has not occurred in the key risk areas. So they're going to look at controls that management has in place over those key risk areas and then test them. But again, they do that on a sample basis. They don't look at them 100%. In addition to testing management's internal control system, auditors always do some amount of substantive procedures. So when an auditor chooses a control reliance strategy, it does not mean they do no substantive procedures. Auditors always do some level of substantive procedures. The reason is management system of internal control is not to be assumed to be 100% correct, right? Internal control systems are man-made. Because they are man-made, they break down on occasion. There could be fraud or collusion possible, right? So auditors, while they may test internal control to a very large degree in the course of an audit, they always do some amount of substantive procedures. In an audit which has a substantive approach, they would do a lot of substantive procedures and potentially no or very little testing of internal control. And so you also have a mix, right? You'll have a mix where auditors will say, well, we can rely on some internal controls, but we have to look at substantive procedures in certain areas, okay? So just to give you an example, the auditors might say management's internal control system over the sales cycle. Okay, the sales cycle is sales, accounts receivable, and cash. Okay, that cycle. The auditors may say the internal control system is strong. And so we're going to audit controls in that system and do only a few substantive procedures. However, the auditors then might look at management's purchasing cycle. The purchasing cycle is purchases, accounts payable, payments, okay, that accounting cycle. The auditors may conclude the internal controls that management has over that cycle are poor or weak. So in that case, we're not going to rely on internal control. We're going to do more substantive procedures. Okay, so these are the types of decisions that the auditors are going to have to make in their planning process. So we identify the risk areas, right, the key risk areas. We respond to those key risk areas by doing internal control tests and or substantive procedures on a sampling basis. So we gather our audit evidence based on doing these tests, and then we have to conclude. Right? We have to review our audit findings. We have to evaluate them. And then based on our evaluation of the audit evidence, as we've already talked about, we form our audit opinion and issue our report. Okay? So the next part of what we're going to walk through here in these PowerPoints is going to talk more about the risk assessment process. Okay, and as we move through the remaining chapters, we're going to move through a discussion of course, responding to the key risk areas in the audit and how we do that, and what type of controls management should have in place, and then talking about the ending process in terms of audit reports. But again, we've talked about the types of audit reports already, right? The unqualified or unmodified, the modified, adverse, right? The disclaimer or denial. So we know the varieties of audit reports, but how do we make that decision, right? In terms of which of the reports we're actually going to issue. Okay, and so that's what we'll discuss later in the course. So one thing to realize is that as auditors conduct their audit, it's what we call an iterative process. Iterative is ITERATIVE, iterative. And iterative means that we have a starting point and we proceed towards the ending point. But during the course of the audit, we may have to back up, right? So we go part way, get some new information. We say, oh, I have to go back and do something else. We back up in the process, then we go forward again. Then we find out some new information, say, oh, I have to change my audit plan. I back up. I have to go forward again, okay? So it's iterative. We're going back and forth as we gather information. So the audit process is an ongoing process. During that process, communication, of course, amongst the audit team members is very critical because, and this is referring to the audit team members, we're talking about the firm doing the audit. They need to be talking to each other. Why? Because they're gathering audit evidence, right? And they need to be sharing that amongst each other. So all the audit team, right, has a consistent view of what's going on as part of the audit process. Throughout the audit process, documentation in today's world is very important, basically because of lawsuits. If you are unfortunate where an audit firm is sued, it's critical that they have documented, right, their reasons that they made decisions in the audit. So document their audit decisions as they proceed throughout the audit, and document their evidence, right, their findings. So why did we make certain decisions? It was on the basis of certain evidence, right? So we should be explaining in our audit file the key decisions that we're making as we go through the audit process. The third point talks about making changes or revisions to a risk assessment and the planned responses to the risk assessment, if appropriate, due to knowledge obtained during the audit process. So this is the iterative part of the process I mentioned. We plan the audit before we start it, but then as we start the audit and we start doing the procedures, we gather more information, right? We say, oh, if I'd have known that information before, I'd have made a different decision. Well, auditors have to go back, change their decision, and then maybe expand their audit tests or do a different type of audit test, and then they get more information, right? And they say, oh, well, in light of that information, I should have done something in additional or different, and then they go back and revise their risk assessment and their plan response being the procedures that they do, okay? So really planning, yes, you start it at the beginning of the audit process, but it really continues throughout the entire audit because you have to have the vision of what's your risk assessment as you gather audit evidence. And should you be changing the procedures that you're doing during the course of the audit based on the risk assessment or the new information, right, that you're gathering throughout the audit process. Throughout the audit process as well, it's key that you have ongoing communication, right? So very often management will ask you, how are things going in the audit? Well, don't rely on management to ask you. The audit firm needs to have a proactive approach in terms of communicating with management and the board of directors in terms of the progress of the audit. They usually communicate with the board of directors, those with governance, through the audit committee, right? So we mentioned before, public companies have audit committees. Usually they're fairly small, 3 people typically, usually someone who's got a financial reporting background, so usually a CPA. Very often there's a lawyer involved on the audit committee to handle legal matters. And then a typical third person would be someone, a banker, for example, someone from a lending institution. Right? So sort of those 3 different mindsets on the audit committee. They're aware of what audits are, can deal with the auditors if any problems are arising, that type of thing, right? So you want to have ongoing communication so there's no surprises, right? It's like running an audit course or any courses we have at the university, right? We set a course outline, right? So we say, here's the material we're going to cover, here's how your grades are going to be determined in the course. And so we try to have good communication, right, with students as we go through the course to minimize any surprises, right? Because nobody likes surprises. Things, of course, have been made a little more difficult with COVID because we can't get face to face. So communication, right, is a little different. We obviously communicate more through email, through lectures, right, such as these, online, right? We can do Teams meetings, right? So we can use technology tools to maintain adequate communication. But it is a bit more difficult, right, than if we were face to face. So that's unfortunate given the COVID situation. But as you know, it's something we're all living with currently. But it's like communication is important in a course. Communication is very, very important during the course of an audit. So the idea here is the audit process is very fluid, right? It's very fluid. It's ongoing. It's changing as it's done. Okay? It's not something where you just do your planning and then you never look at it again until the audit's done. No, it's much different than that. Okay. Independent audit engagement characteristics. The first bullet point says a wide variety of organizations or entities are required to produce financial statements to meet their external stakeholder information needs and to have them independently audited. Right? So, of course, we've talked before about the importance of independence. Audit report today actually refers to, right, the auditors being independent. And we talked about financial statements being required to meet the needs of various stakeholders, such as public company stakeholders, lenders. Right? The next point is that at the outset of the audit engagement, it's important for the auditors to understand what kind of entity is being audited, right? So that's the nature of the business, right? Is it a for-profit company? Is it a not-for-profit company? Is it a government entity? Is it a privately owned business, right? Is it a public company? Next, who the people are who are charged with the governance of the entity. So specifically, who are the members, right, on the board of directors. And sometimes, of course, in private companies, the shareholders, management, and the board of directors are all the same people, right? Because in a family business, you typically have mother, father, they're in the board of directors, they're the key management members, right? So in a private company, the board and management will be the same people. But in a public company, right, they're not. The board is independent, right, of management. We have to know who the stakeholders are. Again, private company versus public, and as well other interested parties such as banks. And then the client's reasons for wanting an audit. Is it, is it something that's required by law? So, for example, public companies must be audited in North America. Or perhaps a private company is interested in becoming a public company. And in order to do that, they need audited financial statements for 5 years before they actually go public. So maybe that's the reason that they wanted to be audited. Or maybe the company wants to be better able to raise new financing, and they need audited financial statements to do that. Okay, so there can be all kinds of reasons, of course, that audits are required. But the auditors need to be aware of what those reasons are. Okay, so we talked about before about the fact that auditors have to decide, are we going to accept, right, the engagement or not? And again, it may be a brand new engagement for the first time, or it might be what we call a repeating or recurring engagement. So before we actually start the actual audit, we already mentioned we perform risk management procedures. Right? Why do we do that? Auditors try to reduce the risk, right? The risk of something going wrong by carefully managing the engagement. Right? So that's the risk management process. And then we've talked previously about the fact that we have to have quality management. Right? Auditors have to manage their audit in accordance with the quality control standards set by the profession. Right? They just can't go do an audit. There are quality control standards that have to be met. So these are part of the professional ethics requirements. So when auditors have to decide whether they want to accept an engagement or not, we can see in the heading in this PowerPoint, audit engagement acceptance and continuance. So you may accept an engagement, but you may not continue in future years. So it means every year, the audit firm has to decide, do we want to continue with this audit client or not? So when we do client selection and retention, the PowerPoint tells us this an important element of an accounting firm's quality control standards and procedures is a system, right? We have to have a system in place. Should we accept a new client or not? And for an existing client, should we resign from the audit or not? So all the firms, in order to control, right, their client selection and retention, they have forms that have to be completed each year. So for a new client, there's typically a 2 or 3 page form that has to be completed to determine whether you want to accept the audit engagement or not. So the form will ask questions such as, are we aware of who the key stakeholders are? Do we have personal knowledge of the board of directors? Right? Are we familiar with the company's bank? Have we had discussions with top management on accounting and financial issues, right, before accepting the engagement? All these types of questions, and essentially asking ourselves as an audit firm, are there any reasons why we shouldn't be accepting this engagement? And again, of course, for an ongoing engagement, if, for example, a major fraud, right, was discovered at a client and we had not reported on that as the audit firm, do we want to resign from the audit, right? Because can we really audit the company if there's a fear of lawsuit from the company, right? Maybe we need to resign from that audit engagement. The whole reason, right, that we go through the client selection and retention process is part of the risk management process. Right? We have to decide, we don't want to accept clients that have high risks, right? We don't want to accept clients, even though they're a current client, we don't want to accept the recurring engagement if the risk of those engagements are too high. Right? So as the PowerPoint note says, accounting firms are not obligated to accept undesirable clients or to retain existing clients. Now, once they accept an audit client, normally 99.9% of the time, they do retain them. Right? There has to be something wrong in order for the firm to give up an audit client. The most common reason, actually, for a firm giving up an audit client is that the audit firm has lost confidence in management. Right? We're just saying we don't believe in management anymore. We can't trust them. Right? Well, if we can't trust management, that's not a good thing, right? As an auditor, so that's actually the main reason that audit firms will resign from an audit engagement. Of course, the other situation would be where there's a fraud or something like that has occurred. Could be legal ramifications, right? Again, it might be better for the audit firm to withdraw because, as we've talked previously, there could actually be fear of intimidation, right, by management on the auditors if they continue in a situation where potentially they could be sued, right? So this is a difficult situation for auditors that they often are going to have to deal with by actually resigning from the audit. Okay. As we look at our acceptance and continuing decision, a number of things that we will do as part of that process. So let's just walk through a number of procedures that auditors will consider in their acceptance and continuance decision. So the first one says, evaluate the auditor independence and the ability to comply with other relevant ethical requirements. So we've already talked about the fact that auditors must be independent, right? If you're not independent of your client, you can't accept the engagement. And if you have an existing engagement and you're no longer independent and you cannot reduce, right, the risk around the lack of independence to an acceptable level, you have to resign. The second bullet point says obtain information from the prospective auditee's management in order to understand the business and its risks. So normally what you do is before you accept the audit engagement, you'll get a financial statement, right? From the prior year, maybe the last 2 years, and you review the financial statement and you look at the audit report that's been issued in the last 2 years. Hopefully it's an unmodified report. If not, you want to, inquire as to why the report was modified in prior years and whether the actual event that led to the modification still exists. Maybe there's still some risk with respect to whether you want to accept this audit or not. But you're going to have a discussion with management, right? So I remember, when I was doing this full time in terms of being an audit partner, you would have discussion with the management that you were looking at taking over the audit for and get some background information. Part B of that says assess whether the organization's managers are able to accept responsibility for preparing the financial statements in accordance with IFRS, for example, and for implementing adequate controls to reduce risk of error and fraud. And so this is simply a question you're going to ask management, are you prepared, right, to accept your responsibility for the financial statements and in a public company for implementing internal controls, right, to reduce the risk of fraud or error to an acceptable level. They have to be prepared to accept those responsibilities. If not, you're not going to accept the audit engagement because as auditor, those are not your responsibilities, right? Those are the responsibilities that management has to assume. 3, we've already seen this. Does the firm have the competence and technical competence, is what that's referring to, and the financial resources, right, to take on the audit? So again, the small Windsor firm probably should not take on the audit for General Motors. The fourth point, consider whether the audit engagement requires special attention or involves unusual risks. Again, maybe there are risks, right, that are too high in this particular engagement, and your firm doesn't want to accept them, right, because perhaps your firm is too small, right, compared to the risk that's present. Okay, and for new auditors, for new audit engagements, you always communicate with the previous auditor. You ask the previous auditor, are there any circumstances that I should be aware of that I should consider before I accept the audit engagement? the previous auditor normally will write back and say, no, there are not any special circumstances that you need to consider. Okay, or if there are, of course, the previous auditor is expected to notify that the new auditor or the new potential auditor that yes, there may be issues that you should be discussing with management around financial statement reporting. Right? The previous auditor, unless they get the consent of management, cannot reveal, right, the detail around what the problems are in the past. Okay, uh, if they get consent from management, yes, they can reveal what the nature of the problems are. But without that consent, they can only review or state in a general way to warn, right, the potential new auditor that yes, there are issues, right, that they need to be aware of. Okay. The auditor knows, right, are the financial statements presented in accordance with generally accepted accounting principles or not, right? So you can tell that from a review of the financial statements. Does management understand its responsibility to prepare the financial statements and to design the control system to ensure lack of material errors, right? So again, that was in the previous PowerPoint we just read. And a key point as well to discuss with management before you accept a new engagement is management prepared to sign at the end of the engagement what we call a letter of representation. Okay, the letter of representation will say things like management agrees that they are responsible for the financial statements. Management agrees that the financial statements properly use international financial reporting standards or whatever the other accounting framework is in the circumstances. Okay, management agrees that all assets are recorded and properly valued. Management agrees that all liabilities are recorded and properly valued. Management agrees that all revenues are recorded and are accurate. Management agrees that all expenses are recorded and are accurate. All these representations are made in what's called the letter of representation. It's usually between 1 and 2 pages long, but it's basically a situation where the auditors are having management acknowledge, right, they're responsible for giving the auditors all the information they need to prepare the financial statements and to conduct their audit in accordance with generally accepted auditing standards. Management cannot withhold any information, right, from the auditors. And so the letter of representation is simply there to essentially have management confirm, right, that they have given everything that's required to the auditors to have them audit the financial statements. Even though management signs the letter of representation at the end of the audit, okay, that does not relieve the auditors of doing proper audit procedures. Okay, so it's not a case where auditors can say, oh, well, management said it was okay, so it doesn't matter whether we did proper audit procedures or not. No, that's not the case. The auditors have to conduct their audit in accordance with generally accepted auditing standards. They do that by contract, right? The engagement letter that we already talked about. So auditors are on the hook to do a proper audit, even though management signs off at the end of the audit and says, yep, everything's okay as far as we know. Okay, so the auditors must get this letter of representation from management at the end of the audit, but the auditors, of course, must also be competent and do a proper financial statement audit. In order to, talking about retention or keeping audit clients, right? It says decisions to continue an existing engagement are similar to acceptance decisions. So again, you'll have a form at the audit firm. It's usually just, again, 1 or 2 pages, and it's going to ask you, right, are there any issues that have come up during the course of the audit that we need to be concerned about? Is the audit client financially sound, right? And because you're making these acceptance decisions, right, for a recurring client, you're going to have firsthand information, right? You'll have actual experience with management and when conducting the audit. So you'll be in a position of having more information, right? And of course, by annually doing a retention review as to whether you're going to keep the client or not, things change, right, from year to year in a client's business. And even the members of management might change, right? Might be a new CEO, might be a new CFO. So people changes, other changes in the organization, financial changes, right? All these things are changing, so we need to consider our risk, right, each year as an audit firm before we decide to whether we're going to go ahead and conduct the audit or not. I've already mentioned that, yes, communication must take place between the successor auditor. So if your firm is going to be the new auditor, you're the successor auditor, and the predecessor auditor. Right? And again, the rules of professional conduct, as we see here, require the successor, the new auditor, to contact the predecessor, right, to see if there are any issues that should be considered before you accept the engagement. And again, obtain information from the predecessor for planning the audit. Okay, so if a new auditor is appointed, the previous auditor, under the professional standards, must cooperate with the new auditor and give them copies of information that's relevant to help them complete the audit. Remember, the audit profession is important, and they want to ensure the public interest is protected. Right? The profession doesn't care as much about individual firms. They care more about protecting the public, because it's only by protecting the public that we keep auditors around, right, and keep them in business. Okay. When a predecessor auditor receives a letter from the new auditor, they have to respond. And you have to respond within a reasonable time, which normally would consider be within 1 week. Okay, so you receive a letter, the predecessor receives a letter from the new auditor, they have to respond. It used to be, up until about 10 years ago, there was nothing in the rules of professional conduct that said the old auditor, the predecessor, had to respond to the successor. And because, of course, when firms lost audits, they would be upset about that. Sometimes they would not cooperate with the new auditor, right? So this caused a problem for clients. So the audit profession changed the rules of professional conduct and said, no, if you lose an audit, you have to cooperate. Right? The former auditor must cooperate with the new auditor. Why? To protect the public interest, to protect the client. Okay. Again, the successor should ask the client to consent to discussions with the predecessor, right? And so it says consent is not required. The communication must take place. Okay, so you should ask the management, hey, can we contact the predecessor? And hopefully they should say, yes, you can. But what this is PowerPoint is saying, even if the client says you can't, you still have to, right? As the new auditor. Why? Because you want to know whether there's risk, right, involved in accepting this new engagement or not, right? And so part of that risk management is being able to contact the predecessor auditor. So under the rules of professional conduct, even if management says you can't, you must, right? So you have to explain to management that you're required under the rules of professional conduct, which you have to meet, right, to conduct the audit. You have to contact the previous auditor. So normally that's not an issue, even if there are reporting issues or audit problems. Okay, management will say, yes, you can contact them, because when you inform them, oh, that's required, you have to do that, okay. So very often management takes a viewpoint. They will allow the auditor to do whatever they need to do, right, to complete their audit. It's just management doesn't want you to do anything in addition to the actual requirements, right? So if you tell management, hey, we are required by the rules of professional conduct to contact the previous auditor, they'll say, okay, go ahead, if that's something you must do. So the idea of not consenting, that would be extremely rare that would happen, okay? Again, management wants a clean, unmodified audit report, which means they have to cooperate, right? Okay, so let's have a look here. Auditors' risk from accepting an audit engagement. So some of the other things that auditors are going to ask themselves in assessing the risk that they're undertaking when they accept a new engagement: how widely distributed are the audited financial statements? So are there 5 shareholders in this company, or are there 5,000 shareholders, right? The greater the number of shareholders, the more risk there'll be. How strong is the financial condition of the auditee? The weaker your audit client is, the more risk there's going to be, right? That there could be a material error in the financial statements. both in terms of numbers and in terms of financial statement notes. How trustworthy, right, is management? I mentioned earlier that typically the reason auditors resign from an audit engagement is they can't trust management anymore, right? And so if you don't think they're trustworthy, why would you accept an engagement to start with? The next point, how complex, right, is the financial reporting? So if we're dealing with a private company, normally the financial reporting is not complex. The notes to the financial statements might be 5 pages to 10 pages. But in a public company, right, as we've seen, the notes of the financial statements can be 50, 60, 70, 80 pages, right, 100 pages of additional financial statement notes. So the more complex, the more risk, right? Because the more pages of notes you have, the more something could go wrong, be misinterpreted, right? Some of the data may even be incorrect. What's said in the report may be incorrect, right? So the greater the complexity, the higher the risk. And then in terms of the users of the financial statements, how knowledgeable are they, right? So if we have 5,000 shareholders, right, are they just average persons that really don't know that much about accounting? So if they're not sophisticated or knowledgeable, there's more risk. If the shareholder group is a small group, right, and they are knowledgeable in finance and accounting, then the risk is lower, right? So the auditor looks at the client's financial statements, but the environment, right? We can call this the environment in which the audit is actually being conducted. Okay, so I've been going on for quite a while now, so why don't we just take a 5-minute break, okay? And I'll come back and we'll finish off the lecture for today. Okay, so see you in 5 minutes. It talks about what management's going to do, and it talks about what the audit firm is going to do. And normally, a new engagement letter should be obtained every year to ensure that there's a common understanding between management and the audit firm. Okay, that's how we avoid misunderstandings, is by putting everything in writing, hopefully. If the decision is made, right, that we're going to go ahead and bring this new client into the firm, we have to appoint staff to be on the audit. And with respect to the audit, we appoint what's called a full service audit team. So normally that means you're going to have, of course, the auditors themselves, but you'll also have normally people who are involved from your tax group, okay? And you may have other forms of specialists involved as well. So you may have company audit team members who are involved in the conduct of public companies, right, in terms of preparing financial statements. In addition, for a public company, there's normally a second partner that's involved, so that the audit partner is not left by themselves. Okay, and in order that the partner can have someone to bounce problems off of, then they need to ensure that they have that second person available to them. And so this reduces the risk from the audit firm perspective. In the context of setting fees, of course, one of the ways you do that is create a time budget. Right? How many hours is it going to take us to actually do this work? Audit firms are in business, of course, to earn a profit. And in order to do that, they have to control the amount of time that they spend on the audit. So they're going to propose a certain number of hours. So let's say in a large audit, it might be 10,000 hours of audit work, but then they're going to split up that audit work. They'll have audit work that will be done on an interim basis. So let's say your client had a December 31st year end. Part of the audit will be done, let's say, in August, September. A little more of the work might be done at a second interim visit, or what we call a pre-year end visit, maybe November, December. And then the normal, what we call year-end work, is shortly after the December 31st date. The audit team would go in to complete what's called the year-end audit work. So in public companies, auditors are usually there at least twice a year, sometimes 3 times a year. Okay, it depends on the situation. At least twice, but very often 3 times. Okay. And of course, when the time budget is set and the timing is set, that's all discussed with management, of course. Okay. In terms of the actual time budget itself, as this PowerPoint says everyone on the audit reports time taken to perform the audit procedures. So time is reported usually on a daily basis today using computer systems. Individual staff members will upload their time. So the engagement management team can look at how much time they have on the audit, on a daily basis if they want to. Normally, they just look at it weekly to determine whether they're getting into trouble or not in terms of are they spending too much time in the audit compared to the progress where they are in terms of completing the audit work itself. The time reports that are prepared by the audit team members, they're used for evaluation purposes. So audit staff members at the end of the audit are evaluated. So if you had a section of the audit was supposed to take 100 hours, if it took you 150 hours, why did it take you 50% more? Were you just unsure what you were doing? Was it your first time doing an audit, right? Did you just waste a lot of time, right? So the supervisor will get into those things with you, right, to have an accounting for why it took so much time. Maybe the audit budget was too low, right? Maybe the audit budget should be higher, right, in terms of hours. That'll be used for billing the client, right? So the way public accounting firms work is that they have what they call recovery ratios, right? So let's say they're going to bill a client $1 million. Does that mean they have $1 million of time value on the job? No, they probably will have more like $1.5 million to bill a client $1 million. So they'll have recovery ratios. So if they had $1.5 million of time and they billed the client $1 million, they would say our time ratio, our recovery ratio was 67%. Right? We had to write off a third of our time, and so our recovery is 67%. For a public company audit, the recovery ratios are usually in the range of 60 to 65%. For private company audits, usually the much more time is recovered, and the audits tend to be less complex, more efficient. So the recovery ratios for those types of audits will usually be in the range of 75 to 95%. Right? So normally public company audits are much more efficient than public company audits. It's just that they're really, in today's world, very often there's not that many private companies that are audited anymore. So audit firms will accumulate all their time. When they accumulate their time in their time records, what they do is they assign what's called a billing rate to each person, right? So it's not, the billing rate is not what the person is being paid. It's the retail rate that they're going to charge their client, or try to charge their client. So for example, if someone's being paid $20 per hour, their billing rate is going to be probably $60 an hour. Public accounting firms usually work on a 3-to-1 ratio. The reason it's 3-to-1 conceptually is 1/3 of the rate, so 1/3 of 60 goes to pay the person doing the work. 1/3 of the 60 goes to overhead of the accounting firm, and that leaves hopefully a third for profit. But as I said, very often the profit element, right, is well below the 60%. Okay. Sorry, below the 30%. So again, it depends on the recovery, but public company audits are high profile, but they tend not to be all that profitable. Okay. So you have to have a lot of them, right, in order to spread your costs amongst a lot of audits. Okay. And then of course, based on our actual time experience this year, did we, if the whole time budget was 10,000 hours, did we do it in 10,000 hours? Did it take 12,000 hours? Did it take 8,000 hours? How can we increase our efficiency next year, right? What mistakes did we make this year that we hopefully won't repeat next year, right? And or do we need to talk to the client about having a higher fee or not? Right? So all those questions need to be addressed at the end of the audit once we experience the audit process. Okay, I mentioned earlier today when we first started, I said understanding the client's business, right, is extremely important. The environment in which they work, because you won't want to identify the risks, right, from the audit perspective. So understanding the client's business and their operating environment is very important. It helps us to assess the risks that the financial statements might contain material misstatements. And if we understand their business and we understand the environment in which they operate, we use that information to develop our audit strategy, right? To design the audit plan. The audit plan is simply the procedures that we're actually going to do, okay? The timing of those procedures. And the audit programs is just the actual documentation that we have of the audit procedures that we're going to perform. So there's a lot of time that's spent in the planning stage for an audit, right, at the front end of the audit. When we understand the client's business, I mentioned that's so we can identify the significant risks, right? Because during the course of the audit, we have to assess the significant risks inherent in the financial statements. What is the underlying economic reality of the entity's financial condition and their performance? This is what the financial statement should capture and communicate to the users, right? So what's the business environment risks related to the industry in which it's operating, regulations, right, on the type of business, the economy generally, right? And then business operational risk. Right? Operational risk is, does the company have a business strategy, right? How is it achieving that business strategy, right? What investments are they making? How are those investments being financed? Do they have performance measures, and what are they? Right? So we can look at all these things and say, this is all going to be an indication of what's happening in our client's business, right? When we look at the operational risk, that's really internal, isn't it? What's going on in the business itself, business environment, what's going on in the environment around the business. Of course, the environment impacts the business, right? So we have to address all these risk areas in determining the audit risks that we have that need to be addressed during the conduct of our audit. Sorry, I just went ahead one PowerPoint too much here. Okay. So when we do our audit and look at significant risks, so we're just trying to fast forward here. Okay, my computer just froze up on me for some reason. So I'm not sure if you can hear me. So I'm just going to go out. I have to reboot my system. So I'll go out and come right back in. Okay, I'll be right. About that be in doing our audit planning. What can go wrong? So this will, if something goes wrong, that could result in a material error in the financial statements. So again, we look at the risks, right? So we look at the risks in terms of corporate governance, the management quality, related party transactions, internal control system that management has over financial reporting, the accounting policies and of the company, whether they lend themselves to preparation of financial statements that present fairly, information systems, right? Very important in today's world because most companies, of course, are using computer systems to produce their data, and we have to audit those computer systems. Understanding the client's environment risks, right? A few of the PowerPoint items we just saw a few minutes ago, right? What's happening in the economy, what's happening where our client's located, the specific geographic region. Maybe they're having floods, maybe they're having tornadoes. These can, these physical things can, weather-wise, can create risks as well. Depending on the country we're in, what's going on tax-wise and regulating companies themselves. Are there specific industries that might create risk? So in today's world, right, do you want to be an auditor of an oil and gas company, right? Are those companies going to survive, right, if we're going to go to clean energy, right? So those types of things can have, of course, greater risks associated with them. Now, auditors do something called analytical procedures. Okay, analytical procedures are high-level procedures performed by auditors to and they're performed at various points during the audit. They're performed at the beginning of the audit as part of the planning. If we want to understand a client's financial position, what is their debt to equity ratio? What is their gross profit margin, right? So we can do all kinds of analysis compared to prior year, compared to the prior 2 years. So that's very helpful in engaging, right, whether our client's in a solid financial position or not, or it might raise other issues, questions that we have, right, just by looking at the underlying data. Similarly, at the end of the audit, right, the partners normally do a analytical review as well. The staff do it for them, the partners review it. And when they review those numbers, the partners want to ensure, right, are the ratios that we're looking at typically, are they consistent with the previous years? Or if they're not consistent with the previous years, do I understand, right, as the audit partner, the changes that have occurred in my client's business, right, and why the numbers are different? Hopefully I do. There are a number of different types of analytical procedures that auditors do, and these are all straightforward things we could all think of if we took a few minutes. The first one, compare current year account balances with one or more comparable periods. So we might compare accounts receivable this year with the prior 2 years. Right? And are they consistent? Are they increasing, decreasing? Why are those trends occurring? The second point, compare the current year account balances and financial relationships with similar information for the auditee's industry, right? So if we audit several retail stores, right, retail clients, why is the gross margin in one client, right, 53% versus another client is 38%, right? Why are those ratios different? Right? So that's helpful when you're knowledgeable in a particular industry. You can easily compare. The next point, compare current year account balances with the company's anticipated results. So if a company did a business plan, right, if we thought sales would go up 20% this year and they actually went down, what happened, right? Why was our projection incorrect? The next point, evaluate the relationships of current year balances to other current year balances for conformity to predictable patterns. So if we look at inventory and accounts payable, right? If inventory went up 20%, then accounts payable go up 20%. We would expect that trend to be predictable, right? Because if inventory went up, we probably owe our creditors more money. Or if our accounts payable went up, did our inventory go up? Right? So we're looking at relationships between data to understand, does it make sense or not? Do we understand the trends, right, which have occurred in the client's data? The last point says study the relationship of current year balances to relevant non-financial information. So what that's saying, so for example, if wages went up 20% this year, right? Wages are a function of what? Number of people that we work and what they're paid, right? So if what they were paid stay constant in terms of a rate, let's say $15 an hour, right? So if that's constant between 2 years and wages went up 20%, that means, did we hire 20% more people, right? If we had 1,000 people working for us last year, do we have 1,200 working for us now? That's relating non-financial information, the number of people, to the wage expense and saying, does that make sense? If wage expense went up 20% and our wage rate is the same this year versus last year, right? But the number of people we employ went down, that's an indication there's something wrong. Right? How can wages go up when number of people working go down? Right? So inconsistent trends, right, between non-financial data and the financial data. Next PowerPoint says analytical procedures are most effective when integrated with other sources of information. So looking at the client's financial statements, right, in planning the audit or at the end of the audit, that's helpful. But we don't have to do that in isolation, right? What else can we do other than just looking at the data? So the next point says review accounting misstatements discovered in prior years. So when we look at our audit files, does management consistently understate the depreciation? Right? We might want to look at that. How about discussing, right? Discussions with the client's personnel, discussions with the controller for the business or other accounting staff, what's happening, right? Or even if sales went up 20% this year, talk to the VP Finance. VPs of marketing. Did sales go up 20% this year? If so, why? Did you get a new customer, two major customers, right? What's happening that's causing your sales to go up? Just talk to people. The next point, review the corporate bylaws or legal documents. So that's just an indication of what new contracts did we sign this year, right? That might influence the data that we saw in our financial statements. So maybe we it did enter it. Maybe we bought another business this year, right? And so our sales went up significantly. Maybe we bought a new building this year, and so capital assets went up significantly, right? So we can have all kinds of contracts and agreements that we've signed during the year that will influence what we should be seeing in the data, right? So we need to have knowledge of any new agreements, new deals, right? New purchases that have occurred throughout the year. It tells us intuitively how the numbers should be moving. And of course, looking at the minutes of the board of directors, extremely important as well, because if there's anything important going on in the company, the board is talking about it. As I mentioned, the auditors are really looking for relationships in the data, right? And we do this, to plan our audit, right? So we're doing all this analysis even before we start the audit to do what? It points us in the right direction, right? It tells us where we should be going, where there might be problems, right? And as well, where there aren't problems, more than likely. So we do horizontal analysis, right? Examining numbers across 2 or more years. So normally auditors will compare 3 years to determine trends, right? Look over at least 3 years to determine trends. And then vertical analysis, so looking at how amounts relate to each other, right? So if sales went up 20%, did accounts receivable go up 20%, right? If long-term debt went up 5%, did capital assets go up 5%? So looking at these ratios, right, that are commonly in place and saying, do we understand what's happening in the client's business? Yes or no? Okay. Analytical procedures, extremely important. Now, at the start of the financial statements, usually the auditors will get management's internal or draft financial statements. Okay. And the analysis of those statements might, again, give us data. We're saying it doesn't make sense, right? Some of the ratios are inconsistent with the prior year. That's an indication that maybe, right, there's some errors in those areas where the numbers are not consistent with the prior years based on our analytical procedures, right? So analytical procedures don't take a lot of time to do, right? You're talking probably several hours to do your analysis, but again, they'll point you in areas of higher risk, right? So it's very valuable, very cost efficient, and very effective. Okay. So when we do these analytical procedures, it says also helps to do what? Provide for an organized approach, right? Because it points us in a direction, right? Tells us where to go, where there might be problems. So it's organized in that view. It's pointing us to the key risk areas. Helps us to become familiar with the client's business, right? So that we understand, why did sales go up 20% this year? Why did wage costs go down 5% this year? Right? As we look at all those numbers, we gather information from all the different sources we mentioned and say, does it all, we use the terminology hang together. It just means, does it make sense, right? When we look at the whole picture, okay? And of course, as we gather the data, we're really gathering questions which are relevant, right? The relevant questions are pointed in the areas of high risk, okay? In addition, when we look at management's financial statements, it says the auditor should analyze cash flow statement for irregularities. Right? So the cash flow statement has come to be known as one of the key statements. If you went back in time, sort of in the 1950s and 1960s, the most important statement at that time was the balance sheet. Okay, but then sort of after the Second World War started and companies were expanding in the 1960s and 1970s, the income statement was considered to be the most important statement. The reason for that was because you had to know, could the company generate enough profit to repay debt that it was borrowing, right? So we transitioned from a balance sheet focus to an income statement focus. And then unfortunately, in the 1990s, basically we discovered, you know what? Income statements could be manipulated, right? by recording revenues improperly, recording expenses improperly. What's really important is looking at the cash flow statement. So that's why they're mentioning here, look at the cash flow statement. Why is that important? Because cash is cash, right? You can't manipulate the cash position of a business. And so the cash flow statement is very important. It discloses trends, right? Are we generating negative cash, right, in our business operations? So if we're conducting our business, right, and it's showing we're making profit in the income statement, what should be happening to our cash on the balance sheet? Over time, it should be going up, right? If we profit should turn into cash. But if it's not, right, if we have a cash deficit, right, so if our cash flow from operations and the cash flow statement is negative, but our profit is positive, it's an indication there could be a problem in terms of the measurement of the income. Okay, so that could be a problem area for us. Okay, let's talk a few minutes about materiality, and then we'll end the lecture for today. So we saw when we looked at the standard form of audit report and the CIBC report in particular, we have something called materiality levels. And we already talked even earlier today about the fact that we want to ensure a material error does not exist in the financial statements. A material error is one which is significant to the user because it might affect the decision as to whether the financial statements present fairly. Okay, so as the PowerPoint says here, materiality is one of the first important judgments the auditor must make, since it affects every other planning, examination, and reporting decision. As we go through the audit, we're thinking about what is materiality, what is significant to the user, right? I'm finding errors. Should I be concerned or not? I'm reflecting on what's my materiality, okay? Materiality is what? The largest amount of uncorrected misstatement that might exist in financial statements and still present fairly the company's financial position and results of operations. So if we said $1 million is our materiality, what we're saying is you could have $1 million of uncorrected errors in the financial statement, but the financial statement would still present fairly. It would not affect the user's decision. Right? So you have to see, well, if it went over $1 million, then you're saying that would be a material error because it would affect the decision of the user. Right? So materiality is a very important number for the auditor. Now, in terms of materiality, we have something called financial statement materiality, where, as we just said, information is material and should be disclosed if it's likely to influence the economic decisions of the users. Right? So for financial statement materiality, we're focusing on the user. Right? Would it affect their decision? If so, it is material from a financial statement materiality perspective. Now, when we look at accounting numbers that appear in financial statement, we know that we can't say they're perfectly accurate, right? Because if we studied accounting long enough, we realize accounting is a gray zone, basically, right? We try and get things close. We use a lot of estimates, right? And when we use estimates in accounting, we could make mistakes, right? So we have honest mistakes that could happen. Some degree of inaccuracy cannot be avoided, right? It says unimportant inaccuracies, of course, will not affect users, right? So small dollar amounts, who cares, right? Something's off $2, we don't care. Cash is $10 billion. If it's misstated by $2, who cares, right? That type of thing. We also have to consider the cost of finding and correcting small errors is too great, right? Who cares about the $2 error in cash? To go and find the $2 error, we don't want to spend $10,000 in time to do that, do we? So there's a cost-benefit analysis a little bit when we look at recording of data in financial statements. And taking time to discover all errors, of course, in a financial statement would just take too much time, right? And if we had to spend more time, that means the cost of the audit would be higher. Therefore, in order to leave room for errors, honest errors that would occur in the financial statements, and reduce the probability that the total misstatement exceeds materiality, right? We want to reduce the probability that we have exceeded the materiality limit, auditors use a lower number than financial statement materiality when they do their audit. That lower number is called performance materiality. Okay? So the difference between financial statement materiality and performance materiality, it's there to leave what we call a cushion. It's a cushion for misstatements that were undiscovered by the auditors. Okay? So as an example, what happens typically is financial statement materiality is $1 million. How much smaller should performance materiality be? Right? Because the smaller the performance materiality is, the more work auditors are going to do. More work means more cost, higher fees, right? And so auditors are under pressure. Yes, we need to have a smaller materiality so there is a cushion for unknown errors or misstatements that might occur in the financial statements, but how much lower? Typically, in most audits, okay, of public companies, performance materiality will be approximately 25 to 30% below financial statement materiality. So if your financial statement materiality, right, what would affect the decision of a user was $1 million, performance materiality will typically be in the range of $700,000 to $750,000, right? So something like that. The difference between $700,000 and $1 million is referred to as the cushion. Right? It's the cushion for misstatements in the financial statements that are not discovered by the auditors during the course of their audit. And of course, as a cushion, right, it provides room for the auditors to make some mistakes themselves, right, without the financial statements being materially in error. So when we think about materiality, excuse me, materiality is both a quantitative and a qualitative number. Quantitative because we set an actual dollar amount, right? It's $1 million or it's some other amount. But it's also a qualitative, right, judgment because qualitative in the word context of writing words, right? And so we can't rely solely on quantitative benchmarks because things that we say, right, can also be important. So qualitative, okay, as well as quantitative. Qualitative might be reflected in how we present information, right? Because often information could be presented in a way that might mislead a user, right? So you wouldn't want to do that either. And so we have to keep in mind materiality has both a quantitative and a qualitative aspect. When we set materiality, it says some small misstatements might be material, right? So what might be a case where a small dollar misstatement might be material? Well, if there's a small error that masks a change in underlying earnings, right, or profit of the company, or if there's a small misstatement that hid a failure to meet analysts' expectations, right? If there was a small error that would change a loss into net income, or vice versa, right? So let's say net income per financial statements was $1,000, right? But there's a misstatement where it should have really been a loss of $1,000, not a profit of $1,000, right? So it could be material, right? In terms of, oh, we didn't make money last year, we actually lost money, right? Or when we look at business segments, right? If the information that's presented for business segments in a note to the financial statements is incorrect, that could be material, right, to our understanding of what's happening in certain business segments, right, of the client. Now, when we set materiality limits, we set them quantitatively. Okay, so what I'm going to do for today, I'm just going to stop here for today because I've been going on for almost our full time here now. So I'll stop here for today. We're almost done. We're on PowerPoint 42 out of 47 for this chapter. So next day, and I'm going to need some extra time here, so I'm not going to get into the quantitative measurement of materiality because it's too important of a topic to do quickly. Okay, so next day, Wednesday, I'll start here at PowerPoint 42, finish that off, which will be chapter 5 finished, and then we'll move into chapter 6. Okay, thanks everybody. Have a good day. Again, if you anything you didn't understand from today's lecture, feel free to send me an email. I'll be certainly glad to help you if you're struggling at all with the material. Okay, thanks. Have a good day, and we'll see you on Wednesday. Take care.